Good evening. Namaskar. Jai Siya Ram. My name is Pathik the Traveler and I welcome you to my YouTube channel. I wish you all a very happy Senior Citizens Day. Today, to celebrate the Senior Citizens Day, I have made a video on senior citizens' financial investment problems and solutions. Before I begin, I request all my senior citizens, friends, or the respected senior citizens to please subscribe to my channel if they have not already subscribed and share this video with their friends and colleagues so that maximum number of senior citizens can benefit from this wonderful information. Let's start. The first scheme that comes to my mind when it comes to the investments that are to be made by senior citizens is Senior Citizen Saving Schemes, SCSS. It is a scheme that is backed up by the central government and that's why it is very safe. Anyone at the age of 60 or more can enter this scheme or invest money in this scheme. HUF and NRIs are not allowed to avail this scheme. Exception is those who opted for the VRS or superannuation during the age group of 55 to 60. So once again, although it is compulsory to be aged 60 or more to invest in this scheme, but if you are the one who had opted for VRS scheme or superannuation scheme during your age group between 55 to 60, then you can invest in that. Defense personnel between the age of 50 to 60, 50 to 60 can invest in this scheme. But otherwise, for a common man, the entry age or age to invest in this scheme is 60 or more. The rate of interest that you will get if you invest in this scheme right now is 8.2% per annum, and you will continue to receive that interest rate regardless of the change in the interest rate. Of course, the interest rates in these schemes are reviewed every quarter. Maximum limit to invest in this scheme is rupees 30 lakh as per the announcement in the budget of February 2023. Minimum amount is rupees 1000. Individual or joint accounts are allowed, but only rupees 30 lakh of investment is allowed per account. Interest payout is on quarterly basis on the first day of April, July, October and January. Growth option, that is reinvestment of interest, is not allowed and the interest is paid to your savings account, credited to your savings account. The maximum tenure of this scheme is 5 years and one-time extension of 3 years is allowed. Extension is treated as reinvestment and the prevailing rate of interest will apply at that point of time. So for example, after 5 years, when you decide to reinvest in this scheme by extending this scheme for 3 more years, and right now the rate of interest is 8.2, but after 5 years if it is 7, then at that point of time you will only get 7% of interest rate and not 8.2. That is a very important to be kept in mind. Important point to be kept in mind. Minimum lock-in period is 1 year. Penalty if account is closed after 1 year is 1.5% of the deposit amount. If closed after 2 years, 1% of the deposit amount is the penalty. For the account that has been extended after 5 years, one can close it for no penalty after 1 year of the extension is over. So if you have renewed this account after 5 years, then if you close it, then there is no penalty, but of course at that time also you cannot close it before 1 year. The tax treatment is ETT, that is exemption tax. That means when you invest there is no tax, but whatever interest that you earn is taxable. If the interest you earn in a financial year is more than 50,000, then even TDS will be applied, and whatever amount that you get on maturity, that is also taxable. This is to be kept in mind. Senior citizens can claim a tax deduction up to rupees 1.5 lakh for investments in SCSS under the Section 80C of the Income Tax Act 1961. Individuals can open more than one SCSS account. They may open another account either by themselves or a joint account with their spouse. However, joint accounts can be opened only with the spouse and the initial depositor is the investor who first deposits in the joint account. There was another scheme by Pradhan Mantri senior citizen schemes, or there was a scheme, but that has been discontinued, and that's why I'm not covering it. It was discontinued in the last budget. So the next scheme that is very handy is Post Office Monthly Income Scheme, popularly known as POMIS or simply MIS. It is backed up by government, so there is no risk. It offers fixed monthly interest on your principal amount. Everyone above the age of 10 can open it. So actually it is not only for senior citizens. Any Indian, okay, whose age is 10 or more can apply. All you have to do is just visit the nearest post office for that. Rate of return is 7.5% approximately. The scheme is primarily for capital protection and not for capital appreciation, but at the age of 60 plus, capital protection is more important than capital appreciation. The minimum investment amount is rupees 1500, maximum amount is rupees 4.5 lakh in case of a single account and rupees 9 lakh in case of joint account. So if the account is only on your name, then you can invest only 4.5 lakh. But if the account is a joint account with your wife or your son or daughter or anyone, then the limit is 9 lakh. Maximum limit is 9 lakh. The tenure is 5 years and you can always renew it. The tax treatment is ETT like the previous scheme. That means at the time of entry there is no tax, but whatever interest you earn is taxable, plus whenever you withdraw the amount, that appreciation will also be taxable. Early withdrawal penalty is 2% if withdrawn in the first 3 years and 1% if withdrawn between 3 to 5 years. In case of POMIS, the individual account limit has been raised from rupees 4.5 lakh to rupees 9 lakh, and for a joint account the amount has been increased from rupees 9 lakh to rupees 15 lakh. That means if you want to invest maximum amount in this, go for a joint account and you can invest maximum 15 lakh. For an individual, the limit is 9 lakh. At the interest rate of 7.1%, the earlier income was rupees 2662 a month or rupees 31,950 a year. For a deposit of rupees 4.5 lakh would now shoot up to rupees 5,325 a month and 63,900 a year. For a joint account, this income would be around 10,650 a month and 1,27,800 a year. Please take these figures in approximation. These are not expected to be the perfect figures, but they may give you an idea that compared to your investment, how much interest you can get on monthly basis or quarterly basis. The next best option is senior citizen FD. Generally treated like any typical FD, these senior citizen FDs offer 0.25 to 0.30% extra interest on the principal amount. They are generally safe. Each depositor in a bank is insured up to a maximum rupees of 5 lakh for both principal and interest amount held by him or her in the same right and the same capacity as on the date of liquidation, cancellation of the bank's license, or the date of which the scheme of the amalgamation, merger, reconstruction. So basically, in simple language, the FD is, see, if you invest in bank A, let us say you invest 8 lakh rupees FD, 8 lakh rupees in FD of bank A, then your 5 lakh rupees are insured by RBI. If you invest other 5 lakh rupees in other bank, then that 5 lakh is separately insured by RBI. But if you invest 50 lakh rupees only in single bank, then only your 5 lakh rupees are insured by RBI. So it is a good idea to actually open more accounts in different banks. Generally, one should prefer nationalized banks. Big sized bank like SBI, Punjab National Bank would definitely be better. In private sector banks, you can always once again go for bigger banks like HDFC, ICICI, Axis, etc. Although technically there is no guarantee that a bank will never fail, but by and large these are the banks in which the amount is generally safe, or money invested is generally safe. Okay, and it must be kept in mind that all the earnings, all the interest that you earn on FD is added to your taxable income. Now come to mutual funds. So mutual funds are having too many types. So what should a senior citizen should do is to invest in debt schemes, DEBT, the schemes that invest in bonds or debentures or T-bills, etc. Now the problem is that in the past, these debt mutual funds used to enjoy indexation benefits, but this indexation benefit has been revoked in the last budget of 2023. So the tax treatment of the debt mutual fund is at par with FD, and that's why debt funds are not as attractive in terms of taxation. In terms of diversification, they offer a very good choice, or alternate to the bank FDs. Not exactly the alternate to the bank FDs, but they are good. But when it comes to taxation, there is no added advantage. Now see, a senior citizen should not invest in an equity scheme if the senior citizen cannot wait for 5 years, minimum 5 to 7 years for the money to or become profitable. Because what you need with equity mutual funds is time, and that is what senior citizens don't have. Still, if you are a senior citizen and you are ready to invest a bulk or lump sum amount, you can go for a balanced advantage scheme, and then you can start withdrawing the amount using the systematic withdrawal plan called SWP. Now, how to use SWP? What are the debt funds? How to invest in hybrid funds or how to invest in balanced advantage funds? For that, you need to watch separate videos, or we need to make a separate video. Avoid depending on mutual fund for dividends, because mutual funds do not pay regular dividends, and even if they pay regular dividends, sometimes they simply pay the amount from your principal amount. So mutual funds actually don't pay the dividends like the companies. The dividends that the mutual funds pay is basically the profit booking from the appreciation. So one should not go for basically what we can say dividend payouts from mutual funds. Instead of that, you should go for systematic withdrawal plan. If you have invested in mutual fund for before retirement, like from the age of 51 to 59, or from the age of 40 to 60, you have been investing in mutual funds, is the time to enjoy to the benefits of that investment by going for systematic withdrawal plan. Systematic withdrawal plans are more tax friendly as well, because the income from dividend will be added to your income, taxable income, while SWP will allow you to book profits. And if it is long term capital gain tax, then up to 1,25,000 there is no tax. Please keep in mind that if you invest in mutual fund, especially equity mutual fund, you are taking a big risk. So even if you are an adventurous senior citizen, you should not invest more than 10% of your amount in equity fund. If you understand the risks, that's fine. Otherwise, it is avoidable. Last option is you can buy some dividend yielding stocks. But do remember that overall your capital won't grow much in this method of investing. Plus, there is a substantial risk that you are taking by investing in stocks directly. For that, you should consult an expert. So mutual funds, in that debt funds are okay. Balanced advantage schemes are up to some extent okay for senior citizens. Equity mutual funds are by and large a big no-no. And if you are trying to invest in stock, you should be extra careful, because you are putting your hard-earned money, your principal amount, at risk. So that allows me to end the presentation. I hope you got some idea about how to invest if you are a senior citizen. Please write in the comment section if you have any specific queries, and I will be happy to answer them to the best of my ability. Thank you very much. Good night. Jai Siya Ram.